Most beginners don't lose money because the market is against them. They lose because they enter the market without a system. And if you're investing with $50, $100, even $1,000, that mistake is expensive because every wrong move hits harder when your capital is small. Here's the uncomfortable truth. The market doesn't punish beginners randomly. It punishes predictable behavior. And if you don't fix this one thing, you will keep repeating the same cycle. Invest, lose, stop, then start again later with more fear. This is exactly why beginners lose money investing. Not because investing is risky, but because they approach it without structure. Think about how most beginners start. You open an app, you see trending stocks, crypto coins, maybe an ETF someone mentioned. You buy something that looks promising. Then you wait. No plan, no system, just hope. Then the price drops. Now fear kicks in. You panic, you sell, or worse, you hold and hope it comes back. Then maybe it goes up again, but you're already out. Or you double down on something else trying to recover. And that's how small losses turn into bigger ones. This is not a knowledge problem, it's a structure problem. The hidden risk most beginners don't see is this. Every decision you make without a system becomes emotional, and emotional investing is inconsistent investing, and inconsistent investing is losing investing. So the real question is not, what should I buy? The real question is, what system am I following? Because without a system, every market movement feels like a threat. With a system, it becomes expected behavior. Let me break down the real root cause. Beginners treat investing like an event, something you do once. Professionals treat it like a process, something you repeat. That difference changes everything. When you treat investing like an event, you look for the right time to enter. You try to predict the market. You hesitate. You overthink. And when things go wrong, you blame the market. But when you treat investing like a process, you remove timing from the equation. You focus on consistency instead of prediction, and suddenly the pressure disappears. So here's the shift you need to make. Stop trying to win quickly. Start building a repeatable system that works over time. This is where most beginners get it wrong. They think small capital means they need big returns fast. That mindset is exactly what causes losses. Because when you try to grow $50 quickly, you take unnecessary risks. You chase volatility. You react emotionally, and the market takes advantage of that behavior. Instead, you need a system that protects your capital first and grows it second. Here's a simple framework you can follow starting today. Step 1. Define your investment vehicle. Not 10 options, not 5, one simple structure. For most beginners, this should be a broad market ETF, something that tracks the global market. This removes the risk of picking the wrong stock. Step 2. Define your allocation. Keep it simple. If you're starting small, you don't need complexity. You can go 100% into one global ETF, or if you want slight diversification, 80% global ETF, 20% emerging markets. That's it. No overthinking. Step 3. Define your frequency. This is where the system becomes powerful. Instead of investing randomly, you invest consistently, every week or every month, even if it's $50, even if it feels small. This is called removing decision fatigue. You don't ask, should I invest now? You already decided. You just execute. Step 4. Automate where possible. The less you interact emotionally with your investments, the better your results. Automation removes hesitation. It removes fear. It removes timing mistakes. Now here's the part most people ignore. Step 5. Define your holding mindset. This is where beginners fail. If you don't decide in advance how long you're investing for, every market drop will feel like a signal to exit. But it's not. It's just market behavior. You need to think in years, not weeks, because the system only works if you give it time. This is why beginners lose money investing, not because they chose the wrong asset, but because they didn't stay long enough for the system to work. Now let's address the psychological trap. When you start investing small amounts, it feels insignificant. $50 feels like nothing. $100 feels slow, so you're tempted to take shortcuts. But that's exactly where discipline is built. Because the goal in the beginning is not to make money, it's to build behavior. Consistent behavior leads to consistent results, and consistent results lead to growth. If you can invest $50 consistently without reacting emotionally, you can manage $500, then $5,000, then more. But if you can't control your decisions at $50, more money will only amplify your mistakes. So instead of asking, "How do I make more?" ask, "Can I follow my system without breaking it?" That's the real test. And here's the identity shift you need to make. Stop seeing yourself as someone trying to make money in the market. Start seeing yourself as someone building a system that grows money over time. Because when you operate from that identity, your decisions change. You stop chasing, you stop reacting, you start executing. And that's when investing becomes simple. So if you've been losing money, feeling confused, or constantly second-guessing yourself, it's not because you can't invest, it's because you've been trying to invest without a system. Fix the system, and everything else becomes easier. If you want to stop guessing and start investing with clarity, this is exactly what this channel is built for. Subscribe to Online Investment Compass and start building your system the right way.